I'm joined today by Harvey Bradley, co-head of global rates at Insight Investment. Harvey is among the incredible investors sharing insights at the Fixed Income and Alternative Credit Investment Forum today. Welcome, Harvey. It's great to have you with us.
Morning, Zelda. It's great to be with you. Thank you for having me.
Harvey, passive investing has been popular in public equities. How do investors need to evolve their approach when investing passively in fixed income markets to achieve success?
You're right. The role of passive approach to investing in equity markets or fixed income has become increasingly popular over recent years. In part, the efficiency gains from transaction costs, the liquidity that has been available. But the simple truth when it comes to fixed income is the markets are more inefficient than you see in equity markets. So whilst the median active manager in global equities underperforms their benchmark over the medium term, that's simply not true within fixed income. For global aggregate managers, for example, over a 7 to 10 year time horizon, pretty much all of the active manager universe will outperform that benchmark. Manager selection, of course, remains very important. You want to choose those who are more consistent, achieve higher risk-adjusted returns as measured by things like the information ratio. But what allows active managers to outperform in fixed income is the structure of markets. In global aggregate indices, for example, we're choosing from over 30,000 securities. You need very large, global, and deep teams to be able to cover that whole universe. It's much broader and deeper than equities. That means the market is also more fragmented when it comes to price discovery, accessing liquidity, and there's also things like new issue premium that you can access in active fixed income mandates and take advantage of, and therefore generate above benchmark returns on a consistent basis in fixed income, which you simply can't do in things like equities.
And why do you think investors need to be intentional when they're selecting their SAA or benchmarks? And why do managers need to be deliberate in their portfolio construction?
Being intentional is absolutely crucial when it comes to fixed income markets. We're accessing a number of risk factors in any single decision or investment allocation that we make, whether that's the currency of investments, the currency hedging approach when it comes to a benchmark, duration risk factor, credit spread, things like convexity. These are all very complex, and we need to be absolutely certain what we're accessing and what the return profile that's going to give us. And it's becoming more and more important with the world that we're going into. Volatility has structurally risen over the past 3 or 4 years. Inflation is back. And for example, when it comes to the currency approach when selecting benchmarks, currency volatility was very low in the 2010s. That's different. We've gone from a world of globalization to deglobalization. Inflation is back, and that brings volatility. And currencies will go back to that role that we're taught in the economic textbooks. They'll act as a shock absorber and a stabilizer. So we can't be running unintended tracking error when it comes to benchmark selection or portfolios, as that will give us less desirable returns or increase the range of outcomes that we might experience. But also, when it comes to accessing diversification, benchmark selection is really important. If you were to buy, say, the global aggregate index, within that, you still have a significant exposure to the US dollar within that, close to 40%. You have over 50% of that index in government bonds. So if you were to take a passive approach, for example, even though you've gone for the most diversified fixed income benchmark there is, you still need to be aware of those concentration risks. And that's where active management again can help, dynamically allocating across currencies, across different asset types to ensure that the portfolio maximizes risk-adjusted returns through the cycle.
And what could the decrease in the purchasing of US Treasuries by China and Japan mean for global markets?
It has been the key theme over recent months in terms of US exceptionalism. Is that over? You have seen a lot of the volatility globally brought about by the US administration's policies themselves, whether that's external foreign policy or most high profile in the second quarter with Liberation Day, trade policy, of course. At the same time, investors are wondering, is the balance between fiscal and monetary policy in the US on a sustainable path? Budget deficits are much wider than we might have expected at this stage of the cycle. That brings with it greater issuance needs. And governments are no longer issuing debt at the very low yield levels we've had over the past 10 to 15 years. So that cost of financing your ever-growing debt stock keeps going up. And it brings that question, who is going to buy all the treasuries? And you mentioned the 2 largest foreign investors who have historically had exposure to US Treasuries. China has been running down their holdings over the past 10 years for a variety of reasons. It's around 50% of the total they used to have. We expect that number to keep coming down as they diversify their reserve assets away from the US. And Japanese investors are a really interesting case. They've had no yield available in their home market for 25, 30 years, zero or negative rates at the front end. The macro regime change we've had means growth has picked up in Japan, but so has inflation. And bond markets have responded. Japanese investors now have yield in their own market again. And on a currency hedge basis, they're actually getting a very significant yield pickup in Japanese government bonds compared to things like US Treasuries, but also other global government bond markets. So we would be expecting them to reallocate capital away from foreign bond markets back to their domestic market, and that will make the challenge for the US Treasury to keep financing their deficits that much more difficult because they're going to have to find alternative buyers for US Treasuries.
And the rise of private credit has impacted fixed income markets. We've seen a reduction in defaults and more flexibilities for borrowers, for example. But the growth in private credit has also seen a reduction in the illiquidity premium over time. How do you see this impacting liquid markets or active managers?
Yeah, that's been a very notable theme within fixed income markets in recent years. And as you say, the key story really is that illiquidity premium has all but gone away. You're now 150 to 200 basis points over publicly traded fixed income markets, broadly in line with the amount of alpha you might expect to achieve from a top quartile public fixed income active asset manager. But when we look at where the world has gone to, you mentioned volatility has been low for an extended period of time. Well, liquidity is that much better in publicly traded fixed income markets than it is in private fixed income markets. So whilst volatility may look much lower, if we enter a more challenging economic environment where volatility picks up, that downwards trend in defaults starts to reverse, that lack of liquidity in private fixed income could be a problem. And you may see that illiquidity premium start to rise again. And that low volatility that private debt appears to have, the reality may start to be realized. As and when you want to exit, the price that you may be able to achieve may not be what you would have expected over recent years if you have lots of investors trying to go out of a small door at the same time. And we do think the macro environment we're going into brings with it a lot of uncertainty. That's likely to breed volatility in the medium term. When we think about the two key risk challenges from here for global fixed income markets, monetary policy has been pretty tight. The labour markets globally have started to roll over. The downside risks to growth, that's not likely to be a good environment for credit or default rates. On the other hand, if the economy is able to weather the current macro conditions we have, and inflation starts to pick up again, that's typically not a great environment for credit either. Higher inflation would likely bring with it higher refinancing rates, and ultimately in the medium term, we think credit spreads are a little bit too tight and you're not being compensated for the macro risks that we think are out there. So we do think selecting a top quartile active asset manager, you can achieve similar returns than you might expect in the private debt space.
And given the uncertainty and volatility in monetary policies globally, how should investors be positioned with respect to duration and currency exposures?
Two of the key risk factors you've highlighted there in global fixed income mandates. Our view on central banks is globally, we're now pretty close to where we would see the correct pricing for central bank policy rates over the next 12 to 18 months. Globally, broadly, that's a place where central banks are getting to what they would consider neutral-ish. You have seen some downside risks appear on the growth side. You have seen some labour market weakening. And whilst inflation remains above central bank targets in most places, it's within the range of outcomes where central bankers are comfortable enough to get towards neutral. But we think they'll then take a wait-and-see approach and see how those two parts of their mandates start to trade off with one another. So on the duration side, we have been running overweight duration positions in our mandates to take advantage of that central bank policy rate cutting cycle being priced in. And we do still think in the next 6 to 12 months, those growth risks do remain to the downside, in part because of the delayed impact from the shock we've had to global trade, but also how that might percolate through business and household confidence channels, particularly if the weakness in the labour market continues. But it's been very deliberate where we've taken that duration exposure. It's been in shorter maturity bonds or at the front end of yield curves, that part of the curve that is most sensitive to that central bank policy rate cycle. Given it's now closer to where we see fair value on a medium term, we have been starting to reduce those overweight duration positions. Where we haven't been running overweight duration, and in fact to continue running underweight relative to our benchmarks, is in longer dated bonds. That part of the yield curve is less sensitive to policy rates and more sensitive to things like global demand supply dynamics, fiscal policy, and inflation premium that investors might demand. And when it comes to those risk factors, the balance between monetary and fiscal policy to us still looks a little out of whack. Budget deficits in most markets, particularly places like the US, France, and UK, continue to be higher than you would expect at this stage of the cycle. And that can potentially bring an imbalance between demand for long-dated government bonds and supply of them. So you may see investors continuing to demand ever higher risk premiums to hold those longer maturity assets. So it's a part of fixed income markets that we're still cautious on and would still favour running yield curve steepeners to benefit from those themes. And on the currency side, our current views are we do think the downtrend in the US dollar on a trade-weighted basis will continue with some of the themes that we've talked about. And in terms of alternatives and currency blocks that might benefit, our largest overweight would currently be in the Eurozone. We think the change you've had in fiscal policy within Europe, particularly from the likes of Germany, will be supportive for growth, and it's rate of change that matters there. And unlike places like the US, France, and UK, you're starting from a better debt stock point in places like Germany. So those fiscal concerns simply aren't there. And if investors are looking to allocate away and diversify from US assets, the Eurozone should be a beneficiary of this, and we think there's room for the currency to keep moving higher.
With weakening demand for US Treasuries globally and tariff uncertainty weighing on the US dollar, is US exceptionalism under threat?
We think it's certainly under threat over the next few years. As you say, you've touched on the key points. And really, it's the uncertainty around where policy will go next, what the US's role is in the global economy, and how those relationships with others will look like, particularly key trading partners. As investors, we do think that trend of people diversifying away from their exposure to US assets is only just starting. You will have faster money and higher frequency trading investors have already made some of those decisions over the past quarter. But the slower moving global reserve managers, institutional money typically acts over quarters and years, not days and weeks. So it's a trend we expect to continue. And we would expect the US dollar as a result to start falling. And I think a key theme that the market's going to focus on in the coming quarter or two is going to be around that of Fed independence in the US. The politicization of the Fed. Already quite a lot of headlines around governors being selected, who's going to replace Powell as Fed chair. And that's just another element of uncertainty where investors are going to have to allocate an additional risk premium on US assets moving forward. And in the near term, most government markets have moved in sync with one another. You haven't seen much US underperformance. The US yield curve, for example, remains flatter than others. So we do think there's room for those trends to continue. And it's something we're actively positioning for in our mandates.
What does a weakening demand for US Treasuries mean for investors with a large and increasing exposure to US denominated assets?
We think it means that we need to think more carefully about diversification in our portfolios, whether that's within a fixed income allocation, but also cross-asset. So we need to be certain as to what our currency exposure is to US dollars and be deliberate about any hedging approach we might take within our mandates, possibly consider reducing that to ensure you are getting that diversification. We think within global fixed income portfolios, it means you need an active approach. The US is and will remain the largest part of global benchmarks. It will very likely remain the global reserve currency, but its safe haven status and how it trades in risk-off environments may change moving forwards, and investors may look for alternatives. The most obvious one would perhaps be euro-denominated assets, more stability, more policy certainty looking forwards, and perhaps a safer place to park cash or buy government bonds at times of uncertainty in the world we're in, where the US administration is a key part of that.
With equity valuations, especially in the US, appearing expensive, at least historically, and with base rates remaining elevated, how do you see the relative value between these two asset classes on a forward-looking basis?
We do think fixed income is attractive relative to equities at these valuation levels. The key messages there really is yields have structurally risen over the past 3 or 4 years. You have the highest yield levels available you've had for maybe 20, 25 years, really going back to levels of the global financial crisis. So what does that mean that fixed income can do in portfolios? It can give that income again. So running yields of 3, 4, 5%, depending on currency mix and allocations to different asset types. That's not a million miles away from what you might expect to achieve in the medium term from equities, from dividend rates on the growth side. But the other part is, if the global economy evolves in a less favorable way, which given the amount of risks that are out there is very plausible, fixed income can play a growth role in portfolios again as well. And depending on which part of the fixed income universe or strategies that you're allocating to, that desire for diversification in challenging environments, we do think fixed income can bring that. So income is back. The total returns that were seen 2 or 3 years ago in 2022, very unlikely to be repeated given the starting point, and that relative attractiveness to other asset classes and diversification it can give you, we think makes fixed income a very attractive place to be in the medium term.
With the return of volatility in the macroeconomic and geopolitical landscape, how can active managers exploit this dynamic to outperform passive strategies?
It comes back to volatility being the key ingredient for success for any active managers, regardless of asset class, but true for fixed income as well. It's difficult for us to extract value from active positioning when volatility is low. So take the 2010s in maybe Europe, for example. We didn't have any policy rate cycles. Fixed income markets traded in very narrow ranges, much more challenging for active fixed income managers to outperform their benchmarks. That's not the world we're in now. Volatility has moved meaningfully higher. The key parts being because inflation is back, the business cycle has returned, some key themes, but also the geopolitical uncertainty that currently exists in the global economic and political universe. And when we look forwards, it's very difficult to see that volatility dying down anytime soon because of those key economic, but also key political trends. So if you are able to select a good active manager, you should see conditions where they can meaningfully outperform their benchmark on a consistent basis moving forwards. And another key point for us is, if we think volatility is higher, if we think that need for diversification within portfolios is coming back, one perhaps unloved part of the fixed income strategy universe that could perform very well in that environment is absolute return strategies. Investors were told the story in the 2010s of this is the time for absolute return fixed income because yields are low, you're not going to get the same returns from total return strategies. And it simply didn't keep up because duration kept falling, yields went negative, which feels a long time ago now. You still needed duration. Central banks were buying assets that kept spread assets supported. You needed beta. But in this world of high yields, and we don't think rates are going all the way back to that previous regime of zero or negative, we think volatility stays high. Absolute return fixed income could be in a really good spot to perform where the focus is on maximizing those risk-adjusted returns. So perhaps something investors should give another look in the current environment.
Thank you, Harvey. We're going to need to leave it there and get back to the forum. I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Fixed Income and Alternative Credit Investment Forum.
Thanks so much for having me, Zelda, and I look forward to participating in these events in the future as well.